He's worked with Bansi and Mehta and now working as a transaction advisor at BDA LLP with Sri Gautam Doshi. Has garnered experience in a wide range of areas covering mergers and acquisitions, IBC takeover, succession planning, international taxation, accounting, FEMA, and corporate laws. Actively been in number of acquisition and restructuring transactions. He's also served as a member of International Tax Committee and India's Committee of WIRC. Also served as one of the youngest chairmen of the Direct Tax Committee of Chamber of Tax Consultants, that's CTC. He's been a regular speaker at various professional forums and has contributed articles as well as chapters in various professional books on impact of Section 56 to 10 on corporate restructuring and trust structures, demystifying Section 194R, impact of GAAR on trust structures and outbound structuring post BPs. Let's welcome Abhitan ji. We'll also request Bhavna ji and Vijendra to join me in giving memento to him.
Hello. Yeah. Good afternoon, friends. Uh, Thanks WIRC for giving this opportunity. My topic is very crucial. When I was speaking to my colleagues, the topic as it goes is structuring foreign and domestic venture capital entries in and exits from Indian assets. That's the topic I am asked to deliberate today. So basically, what is structuring foreign domestic venture capital Indian assets entries exit is basically tax planning. How can you look at investing and exiting in the tax efficient manner? That is what we generally as chartered accountants are involved with. But now, to my mind, more than tax planning avenues, we are more and more concerned with not being hit by anti-abuse provisions which are unintentional. We have to make sure 56 to 10 doesn't trigger. As Binoy mentioned in the slide deck on capital reduction, that there is a commercial price being agreed, but there is a different valuation formula prescribed, which results into a tax without any actual income. So, too many complications to be looked at, but if one wants to simplify things, 100% the commercial consideration play the pivotal role. In the first case study taken by Binoy, let's for a minute, Nirma's acquisition of Lafarge. It was a SPV created and a SPV was reverse merged. Why was SPV reverse merged into the company and not a forward merger? There is a general problem in the cement industry because of the mining rights which they have. If they change the entity, the royalty payment shoots up. Therefore, the mining rights, the cement operating company has to continue in the same entity. Why even after post ACC Ambuja acquisitions, the complex structure continues? Because of commercial and other considerations. So, commercial considerations would first decide whether you want to invest, how much you want to invest, how you want to invest. So, assuming a venture capitalist has decided he wants to take a equity exposure to a entity. So that is a commercial decision. Then it comes to structuring that. Should he invest in an equity instrument, in a hybrid share, or a CCD, or a CCPS? Whether he should invest directly into the company, whether he should invest through a SPV, that is all part of the structuring. But with the limited time frame we have, there are 2-3 very key nuances which I would like to have the key takeaways. There is a laundry list of how you will structure. One, you acquire shares, you sell shares. Everyone knows capital gain, period of holding, long term, short term. All treaty grandfatherings are almost through. You would be paying tax. So that is class 101, nothing. Now, if assuming I am coming from a foreign entity, so say if it is based in a USA or a UK where capital gains exemption is not there. So if I interpose a company in a Dubai, or if I interpose a company in Dubai and then or Mauritius, and that it invests in India, so then shares, again DTAA has been modified, that when the SPV, though there is a capital gains article, when it is going to sell the shares, it will pay tax because DTAA doesn't give that protection, but the DTAA is only for shares. So instead of shares, he can invest in CCDs. Can investment in CCDs through a Mauritius structure or a Singapore structure still outside tax ambit? Technically yes, but there are number of news items to say that the tax department has already started examining the structures, started either invoking PPT or GAR to see whether the SPV has a substance, whether it is entitled to the DTAA benefit. You have few AARs in the context of shares. Similar logic has been applied to investment through CCDs as well. So CCD becomes one instrument today which is technically outside DTAA. Going one step further, instead of selling the shares of the Indian company, you sell the shares of the SPV. As in the example Binoy had of a UAE legacy company, that you have UAE 1 and UAE 2. And UAE 1 is selling shares of UAE 2 because the indirect transfer rules don't apply. Again, it misses taxation. But the point is, commercially, you should have a buyer who is willing to take the shares of a holding company and not of the operating company. So this is generally possible if it is 100% cash out. For a partial stake, or if you are investing 20% in a company, one is not sure how much a buyer would be comfortable to get it through a holdco structure and not directly in the company. Third, which is more sought after option, generally is that you invest through a AIF. If you are basically the foreign investor would be putting money in the AIF, subscribing to the units of the AIF, and the AIF would be making the further downward investment. It has similar arguments as CCDs, that it is not shares, it is not covered by the DTAA article, the residuary clause will apply. So units of a AIF, though it is of an Indian AIF held by a foreigner, if it is entitled to a treaty benefit, it goes out of taxation. To my mind, there is a stronger argument for units of AIF compared to CCD, because in AIF there is a separate entity which is a sponsor, there is a fund manager, it is not in your control, so to say, it is a different legal entity. It makes investments which are on a wider spectrum, has rules on concentration and things like that. And therefore, Cat 1, Cat 2 AIF, selling the shares, units could be a possible mechanism of mitigating the tax. But selling units of the AIF again has the similar problem that it is for a group of investments. AIF would have invested in a host of companies. So therefore it is not selling one particular investment. So to find a buyer for a AIF would be slightly different than what a venture capitalist used to. But still the AIF option would work beautifully, especially if it is a Cat 1 AIF for investment in startups, because over there the SEBI regulations permit you to form schemes, separate schemes for every investment. So each startup investment is represented by separate units of the AIF. And therefore then transferring the units of the AIF, it is as good as you are transferring the underlying shares, except that you don't have a management say. What has been now looked at and explored, I would not say implemented as many times as it is explored, is entry through gift city route. For the inherent reason that in India, the fund managers are still not very comfortable with the tax and regulatory regimes which we follow. A foreign fund manager, to tell him to shift or to have an entity in the gift city is not something which goes well. But particularly, if the non-residents are investing in India, it would be worthwhile to look at gift cities taxation, especially if they are investing in CCDs or units of AIF. Why? There is specifically section 10(4)(d) of Income Tax Act to bring gift city in line with Singapore and Mauritius. They have said that gain from transfer of a capital asset other than shares of an Indian company is not taxable. Subject to the fund should only have non-resident investors. So that fund cannot have resident investors, but because they wanted to replicate the DTAA of Mauritius and Singapore and gift city, they have said that transfer other than shares of an Indian company is not taxable. So whatever modus we discussed, be it CCDs or be it units of AIF, is not taxable if one is coming through the gift city route. Then the question inherently is, why should I come through gift city? Shouldn't I come through Singapore or shouldn't I come through Mauritius? Why gift city is a better alternate? Post BEPS, there was a multilateral instrument, MLI was brought in. Singapore, India is a signatory. Mauritius is a signatory but has not nominated India. But Mauritius treaty is already being amended, just the date has to be notified now. What has happened now? If you are using any of the treaty jurisdictions and you are not your fund investors are not the resident of that jurisdiction, then the treaty benefit to you can be denied if the main purpose of coming to the country was to take this treaty benefit. Generally, Singapore one may substantiate based on the facts, but it always becomes a litigative matter, whether I am entitled to the treaty benefit or not. And the Tiger Global ruling and the other AAR rulings which we have, questioning Azadi Bachao, that whether the SPV is a bona fide SPV, whether it is the beneficial owner or not. So those questions which have a huge clout on tax, how it would be, finally be decided, no one knows. In gift city, that risk is significantly mitigated, because then you are not relying on any tax treaty. You are on the domestic law of India. You are looking at a section which is explicit. There is express, there is no play in the reading of the select section, that you are entitled to this benefit. In that scenario, one doesn't see that GAR could be invoked, because main purpose is to come to India, invest in India. Through gift city, you are only promoting. So therefore, one finds that one would have a much better case on gift city as compared to using any of the treaty jurisdiction. So one is, you decide commercially what you want to do. Second, you decide the jurisdiction and the instrument through which you want to invest. Equally important, at the inception itself, you have to see that what would be your possible exits, and accordingly you have to structure your entry into the company target or into India. For example, if I am going to exit finally through a IPO, then all these story about units or CCDs don't work, because when I will take the exit, it would be the shares which I would be selling as part of the listing through OFS. So what is going to be my exit is equally relevant to decide my way of investment. How I want to exit. Do I want to sell the entire stake at one go? Yes, then I can have possibly a SPV structure. But no, I want to sell it in a piecemeal manner. Then better that you have stake directly in the company and not have the SPV structure. Why in SPV also I can do a piecemeal sale? What is the problem? The problem is, assuming if you have formed a wholly owned subsidiary in India, and then you have acquired 100% stake of the operating company in India. Now you are divesting 20% stake. The incoming investor will take the shares of the operating company, is not likely, or in no scenario generally will take stake of the holding company. So the holding company will sell the shares of the Indian company, earn money, pay capital gain, but will again pay tax to send the funds abroad or to remit the funds as dividend. So unless you are selling the SPV structure completely, then better to directly invest, not to have an Indian holdco. But what are the scenarios in which an Indian holdco is preferred? Especially when you are looking at multiple acquisitions. So one of our clients is taking over schools across the country, has formed a SPV below that, is acquiring all the companies which own land and building used by the schools. Because his exit structure is to put this into a REIT. There he needs a holdco. You would have seen multiple times PE funds are making a pharma company by acquiring different drugs of different companies through slum sale, BTA, or company acquisition. When you are looking at multiple acquisitions to be done under a common theme, and then if you want to sell that as a basket and have a premium for having that basket, then a Indian holdco or a Indian SPV works. Otherwise, always investing directly into the target is expected. So this was broadly tax. If you are selecting a treaty jurisdiction, you may have to substantiate non-tax reasons. Practically what we have found, the key non-tax reason which can be substantiated is that if I have investors from multiple jurisdictions. If I have investors from multiple jurisdictions, I have to gather them somewhere. So that is a commercial requirement to have one entity where people from multiple jurisdictions will invest. Then if I select a country which has robust finance laws and is known for its financial depth of the financial market, like Singapore or Hong Kong or UK, then one could easily justify. But assuming if I have all the investors from US, why categorically US? US is capital gain as per the domestic law. And then I come to Singapore and then further invest in India, it would be highly doubtful whether I'll get the DTAA benefit or not. So, coming to FEMA, on acquisition, there are 2-3 teething troubles which one has practically observed. Is that whenever you buy, you may want to keep partial consideration outstanding to be payable at a later date. It may be a absolute number, or it may be a performance linked number based on future profits and sales and margins. FEMA allows 25% deferment of the total consideration. It is, the house is generally divided on whether a contingent consideration is also covered. What is the difference? If the deal is of 100 crores, I say that 20 crores I'll pay after a year. That is deferment of the consideration. If I say that the deal is of 100 crores, I'm paying you plus 10% profit for next 2 years, then I don't know that number. An estimation may be that it is within the 25% range. But is it a deferred consideration? The answer is no, because it is a consideration or not, it is not yet fixed. There could be a loss, there could be zero further payment. So it is a concern to structure deferred consideration in case of acquisition, especially if a resident is selling to a non-resident. It is still okay, broadly one says, okay, contingent consideration is covered. You broadly valuation wise cover within the 25% rule and the 18-month outer limit given by FEMA. The bigger problem is for the LLPs. For LLPs, there is no concept of deferred consideration. In one of the cases, there was a conversion of LLP into a company just to have this deferred consideration clause. What would happen if you convert? That is exempt, but there is a condition that you should continue to own 50% stake in the converted company for next 3 to 5 years. Otherwise, the exemption is invoked. And we are going to give 100% to a foreign investor. So it was, the foreign investor was first told to buy 10% stake in the company, in the LLP, become a partner. Then LLP was converted, and then the remaining 90% shares were transferred. Because the condition under section 47 of income tax is the test on all the partners together should continue to own 51. Inter se change between the partners is ignored for 47. Binoy on pricing guidelines, the one of the key benefits of Indian AIF, if you ask me, is are two or three as compared to investing directly from abroad. All are linked to FEMA. One, pricing guidelines are not applicable. So to establish the value is not something which is applicable, but generally transactions one presumes at arm's length, but many times when you are buying a bigger chunk of the same stock as compared to others, you tend to get a discount. And if the other buyer is a resident, optically at least there is a mismatch of price. So one has to take that commercial stand and risk that, you know, bulk buying may be at a discount or maybe at a premium, depending on the facts. That concern is not there in AIF. Second, if you are going to give a minimum return, if you want to say, I have taken 20% stake in a company for 20 crores and I will be given an exit in 5 years, and the minimum price would be that I get at least a 15% IRR. FEMA is clear that you cannot give a assured return to a non-resident. Whereas for a AIF, though the investor or the unit holder is a non-resident, the conditions don't apply. Because AIF registered in India with SEBI, whose sponsors and manager are Indian citizens and residents, is a Indian entity, and any further investment is R2R. So all the rules of NR2R don't apply when AIF is making the investment. So AIF can even have a clause on guaranteed return. Third, generally the investments by ventures would be in the form of CCD or CCPS. If you issue CCD, FEMA says that it could be a formula-based conversion. You may either decide the price today, or price can be of a future date, but you have to convert based on the pre-agreed formula, whatever formula you have. But then has a proviso that you cannot convert at a price less than the fair value on the date of issuance of the instrument. Therefore, if the value goes south, you cannot convert at the lesser price. If the 100 crore investment value becomes 80 crores, AIF is likely, or an investor is likely to have anti-dilutive clauses to give effect. So every foreign investment will have anti-dilutive clauses, but when it comes to giving effect to that anti-dilutive clause in light of FEMA, practically would become difficult, which again is mitigated if you are investing through a Indian AIF. Yes, sir. Sir, how do you, sorry? There would be that amount of dilution, but it is for the overall scheme or overall fund of the AIF he has to hold. Depends on the overall size, which could be minuscule. Only thing, whatever we discussed on AIF is only on FEMA. The benefits of FEMA is only for AIF in mainland India. For a IFSC AIF, it is treated as if a non-resident is investing in India, and therefore the FEMA benefits don't apply. There, the real play is income tax benefits. Coming to non-tax and non-FEMA issues, which are more discussed and takes most of the time of the deal making, is I have just noted few of them, which are, one is the investor will have a board seat, he will have reserved matters, he'll have affirmative vote. Basically, what we have learned in General Law of Companies Act, that majority can do anything unless it is detrimental to the interest of minority, they cannot question. That is done away once you have a VC. It is reverse, the minority can do anything or stop you from doing anything. For every possible matter one can think of, appointment of KMPs, your budget, any M&A, big acquisitions, any major restructuring, they'll have a laundry list which is there of matters on which they have to vote in positive. Unless they vote in positive, it would be mean that the thing cannot move forward. They cannot tell you to do XYZ, but they can stop you from doing ABC. They cannot tell you, you go and merge with this company. That right continues with the majority. But if the majority wants to merge, they can stop the merger. Nowadays also, one is seeing a extra power which they are taking, that if you are unable to achieve the projected financial results, then their power increases and virtually makes them the majority. Virtually they come in the driving seat, though they only have a 20% interest. Generally one captures this through a shareholders agreement, but there are few duties which are cast also on the directors of the company and the operations of the company, and is not restricted to the inter se shareholder dealing. Therefore, even the articles of the company are modified to provide for these restrictive clauses, with a further article on entrenchment that this cannot be modified without approval of the PE investor. Generally, they have a right of first refusal. If you want to sell shares, they will have a first right to buy. Though they own 20% of stake, they will generally insist on a drag along, meaning that they will decide, if they decide to sell their 20% stake to someone, they can force you to sell your 80% stake along with them. They will certainly have a tag along right, that if you are selling, they will tag along with you, and proportionately their shares would be sold. But generally the drag along right, which is with the majority, VCs do insist to have as a minority as well. Most of the time, is spent on reps and indemnities. Entire day could go by just discussing reps and indemnities. Broadly, if one is on the buyer side, one is seeing that the risk of reopening is high, so give me 10 years indemnity. If you are on the seller side, you will say that risk of reopening under 147 is low, so 4-5 years indemnity is good. So one is the fight on period of indemnity. Second, slightly just covering the tax aspect of indemnity. Second fight is on who will run the process of litigation. Third, who will bear the cost of litigation, which generally goes hand in hand. And fourth, is there a capping on the indemnity? So is indemnity only for the tax plus interest for 2 3 years, or tax plus interest plus penalty plus compounding fee if prosecution is initiated, to what level it is covered, and what is the point of payment? As soon as any demand is received, the amount is paid and then litigated, or the minimal amount is paid and the litigation goes on. It is captured in the most nuanced way possible. Then there is the indemnity on if there is a benefit which comes because of any tax litigation. It would be passed on to the seller because presently that benefit is not factored in. So any benefit will be passed on to the seller. One thing which is not very prevalent in India but has started in few cases is tax insurance. We had a case, it was simple Mauritius company having investment in India. The holdco was in EU. Now the holdco has declared bankruptcy. So they are going to sell the shares of the Indian company which are held by the Mauritius company. Now the buyer is that I can do withholding. If I don't do withholding from you, you're already in bankruptcy. There is no way I'll get back any indemnity or ribs. So they have agreed to take a tax insurance, though the premium is significant, but the sellers found it better than paying tax and claiming refund in India than to take a insurance. So it is coming up in fact specific scenarios to take tax insurance to avoid. Another general discussion is the place of arbitration, generally agreed to be London or Singapore. So now coming to planning is very simple. For shared CCDs, it is 10% or 20%, you have to decide. But what could hit you unnecessarily? If you are buying a majority of a company, say a startup, but has huge valuation but may have income tax losses. So you have to see that section 79, the losses don't lapse. If you acquire the equity, the losses will lapse. Or if you infuse as equity, the losses will lapse. So infuse as any convertible instrument like CCDs or OCDs. Now 56 to 7B is also applicable to non-residents. Exemption is for, again, Indian AIF, it is there. For few countries like UK, US is there, but it is not there for Singapore, Hong Kong, and Mauritius and UAE. Whether you get a 281 certificate or you get a 281 order from your AO, the biggest discussion is always the withholding tax, whether to give treaty benefit or not, how to compute capital gain, whether in foreign currency or in Indian currency, and apply 10% or 20% tax rate. So two case studies which I'll just briefly touch upon. One is if you are doing buyback of CCDs, section 68 doesn't apply to it. So the requirement of 25% net worth, up to 25% of net worth is not there. CCD buyback is not governed by any particular provision of Companies Act. 68 only applies to shares. It doesn't apply to debentures. Therefore, it is general contract law that the parties to the contract have agreed. Therefore, the restriction is not there. So if an exit is to be given by the company out of its profits, a buyback of CCD is equally possible. Second, in case you are having an exit which is non-cash, the problem is it is an exchange of shares for shares. One startup is selling its shares to another startup. The pinch is you have to pay tax on the fair value of the shares, which is very well established by number of investors, reports coming in. So it is as slightly, you are not getting a penny, but you are paying tax. It would be worthwhile to evaluate the amendment to the slump sale section 50B. The new section, the rule which Rule 11 UAE is prescribed, there is a possibility that you can, instead of selling the shares, if you have company A, which is to be taken over by company B, the undertaking, the business undertaking of company A, there is a slump sale done to, slump exchange done to company B, and company B issues the shares to company A. In that case, it is likely that there is no capital gains tax. The negative is the shares are stuck in the company and are not with the shareholders directly. But in fact, one may want to evaluate and consider this deferral of tax. IFSC, just one point. Yes, there is a benefit. 10(4)(d), we have today not discussed 80(LA), but there is a benefit available, possible. What is the biggest downside? If any of the benefit is closed, if a foreign company is selling shares of an Indian company or units in India, 112 provides for a tax rate of 10%. Whereas if the IFSC would be selling shares of an Indian company or units, the tax rate would be 20%. So it is not only that the benefit will be withdrawn, instead of 10%, you will end up paying tax at 20%. I think so. That's all from my side. Thank you for a patient hearing.
Thank you, sir, for your enlightening session. And we extend our heartfelt gratitude on behalf of WIRC for the expertise you have brought and the insights you have shared with your valuable knowledge and the understanding of the subject matter. Thank you so much.